What if I told you that everything you think you know about getting rich is probably wrong? That the images we see in movies, the frantic trader screaming into 4 phones, the billionaire making a killing on a risky bet, it's all a distraction. Because the truth is, the wealthiest people in the world aren't playing the same game as you and me. They're playing a different game entirely, on a different field, with different rules. And the most shocking part, their game is designed to be boring. So boring, in fact, that most people would fall asleep watching it. But while they're sleeping, their money is working harder than you ever thought possible. Today, we're not just talking about investing. We're pulling back the curtain on the secret strategies of the ultra-wealthy. We're going to look at the real, time-tested methods used by high-net-worth individuals to not just get wealthy, but to stay wealthy. And the first step isn't about what they buy, it's about how they think. The number one thing that separates wealthy investors from the average retail trader is their time horizon. If you go on Reddit, you'll see thousands of posts about day trading, meme stocks, and trying to time the market. That's the financial equivalent of going to a casino. It's exciting, it's fast, and it's designed to take your money. But when you read discussions about how the rich invest, one phrase comes up constantly: capital preservation. Let that sink in for a moment. Their primary goal isn't to turn $100,000 into $1 million overnight. They already have the million. Their goal is to make sure that million is still there in 10, 20, or 30 years. They are playing defense, not offense. They are the tortoise, patiently plodding along while the hares burn out around them. This mindset shift from get rich quick to stay rich forever is the foundation of everything else. It changes every single decision they make. So with that defensive mindset, what does their actual portfolio look like? This is where we get into the boring part. You might think they have 100% of their money in high-flying tech stocks, but that's risk, and the wealthy hate uncompensated risk. They don't gamble, they calculate. According to the wisdom shared by experienced investors, the wealthy typically spread their wealth across a wide variety of assets. Yes, they own stocks, but often it's through low-cost index funds that track the entire market, not a gamble on a single company. They want to own a piece of everything, not bet the farm on one horse. But here's where it diverges from the typical 401k. A huge portion of their portfolio is often in assets you and I might not think about every day. Let's break down the big 3 alternative assets the rich lean on. Number 1, real estate. But not just buying a house and hoping it goes up in value. We're talking about commercial real estate, multifamily units, and land. It provides 2 things the wealthy love: cash flow through rent and a hard asset that tends to hold its value against inflation. Real estate is tangible. You can see it, touch it, and improve it. It acts as a hedge against inflation because as the cost of living goes up, so does the rent you can charge, and typically the value of the property itself. It's a fortress against the eroding power of rising prices. Number 2, private equity. This is the secret you actually can't access easily. This is investing in private companies before they go public. It's riskier, but offers the potential for massive, outsized returns that you just can't get in the public stock market. It's exclusive because it requires you to be an accredited investor, which is a fancy way of saying you need a high net worth or high income to prove you can afford to lose the money. Think about it. The average person can only buy stock in Apple after it's already $1 trillion company. The wealthy got to invest in Apple when it was still in a garage. They get in on the ground floor while everyone else is waiting for the elevator. Number 3, bonds and fixed income. I know. Bonds are the definition of boring. They're the financial equivalent of watching paint dry. But for the ultra-wealthy, especially in retirement, municipal bonds are a favorite. Why? In the US, the interest on many municipal bonds is tax-free at the federal level. When you're in the highest tax bracket, avoiding taxes becomes a massive part of your investment strategy. A bond yielding 4% tax-free might be equivalent to a taxable investment yielding 6 or 7%. That guaranteed, tax-efficient income stream is like gold to someone trying to preserve their capital while living off the returns. It's not exciting, but it's effective. And that brings me to the absolute secret sauce of rich people investing. It's not about what you earn, it's about what you keep. The wealthy don't just have a broker, they have a team. They have a tax attorney and an accountant working alongside their financial advisor. Every investment decision is filtered through one question: what are the tax implications? They utilize strategies like buy, borrow, die. Buy, they buy assets like stocks or real estate that appreciate in value. Borrow, instead of selling those assets and paying a massive capital gains tax, they take out low-interest loans against their increased wealth. Loans are not considered income, so they are tax-free. They use this borrowed money to fund their lifestyle without ever selling their assets. They get to have their cake and eat it too. Die, when they pass away, their heirs inherit the assets. In many jurisdictions, thanks to a step up in basis, the capital gains tax liability from when the original owner bought the asset is wiped clean. The heirs get the asset at its current value, sell it if they want, and pay little to no capital gains tax. It's a sophisticated, legal, and incredibly effective way to manage wealth that most middle-class investors never consider because we're too focused on the next hot stock tip. We're playing checkers while they're playing three-dimensional chess. Now, you might be wondering, okay, but what about the actual numbers? How do they allocate all this? Well, every individual is different. There are common threads. You'll often see a structure that looks like a pyramid. At the very base, the foundation is protection and liquidity. This is cash, cash equivalents, and high-quality government bonds. It's the money they can access immediately without any risk of loss. It's their safety net in a crisis. For a wealthy person, this might be 1 or 2 years worth of living expenses, ensuring they never have to sell a stock or a building at the worst possible time just to pay the bills. It's their insurance policy against panic. The next layer up is the growth engine. This includes the public stocks we mentioned, often held in index funds, as well as their real estate holdings. This is the part of the portfolio designed to grow faster than inflation and increase their net worth over the long term. They aren't flipping houses or day trading. They are buying and holding for decades. They understand that time in the market beats timing the market. At the very top of the pyramid is the legacy and tax efficiency layer. This is the private equity, the venture capital, the art, and the sophisticated trust structures. This is where they swing for the fences, but only after the rest of the pyramid is rock solid. They take risks with money they can afford to lose, not with their foundation. So let's recap the rich investor pyramid. 1. The base, safety, capital preservation, cash and bonds to weather any storm. They don't get emotional during market crashes because they aren't over-leveraged. They sleep soundly while others panic. 2. The middle, growth. Index funds, real estate, and maybe some private investments designed to outpace inflation and grow their wealth steadily over decades. 3. The peak, optimization. This is the tax strategy, the estate planning, the art of passing wealth down to the next generation without the government taking a huge bite. Another key takeaway from these investment discussions is the focus on income, not valuation. The average retail investor is constantly checking the price of their stocks. Are they up? Are they down? They get excited by price appreciation. The wealthy, however, are often more focused on income. How much dividend income is this stock throwing off? How much rent is this property generating? They care about cash flow. Cash flow is reliable, it pays the bills and can be reinvested. Stock prices are fickle and subject to the moods of the market. This focus on income also explains their love for private credit and private real estate deals. These are assets that are designed to generate a steady stream of cash payments, often with contractual agreements. It's predictable, and in the world of wealth, predictability is king. It's the difference between hoping your ship comes in and owning the port. So what can you learn from this? Do you need $1 million to start thinking this way? Absolutely not. You can adopt the mindset of the wealthy today, starting right now with whatever you have. Start by thinking long-term. Ignore the daily market noise. Turn off the financial news if you have to. Focus on diversification. Don't put all your hopes on one stock. Spread your bets. Become tax aware. If you're investing in a taxable account, understand the implications of what you're buying. A gain isn't a gain until you've paid the taxman. And most importantly, prioritize protecting what you have while you try to grow it. Build your foundation before you build your skyscraper. Start thinking of assets in terms of the income they produce, not just the potential for a quick price jump. The goal isn't to get rich by acting like a gambler. It's to build lasting wealth by acting like an owner. It's to play the boring game, the patient game, the game that actually wins in the end. If you found this breakdown helpful, hit that subscribe button for more deep dives into the strategies that actually build wealth. And let me know in the comments, what is the most boring investment you own? I'd love to hear it. Thanks for watching, and I'll see you in the next one.